Vertiv Holdings company is one of the strongest beneficiaries of the global AI data center boom. The company provides critical infrastructure, including power systems, UPS, power distribution, thermal management, liquid cooling, racks, monitoring, and other technologies required to keep modern data centers operating reliably. Unlike many AI companies that depend on a specific chip, model, or software platform, Vertiv benefits from the broader expansion of computing infrastructure. As AI servers become more powerful, they require substantially more electricity and generate more heat, creating structural demand for Vertiv's power and cooling solutions. The central investment thesis for VRT is simple. More AI computing requires more data center infrastructure. As hyperscalers and enterprises deploy increasingly powerful GPUs, rack power densities are rising rapidly. This creates greater demand for UPS systems, power distribution, thermal management, and especially liquid cooling. Vertiv is positioned across several of these categories, allowing it to benefit from multiple parts of the data center infrastructure cycle rather than relying on a single product. Vertiv entered 2026 with strong financial momentum. In 2025, revenue reached approximately $10.2 billion, representing roughly 28% year-over-year growth. Operating profit increased approximately 34% to around $1.8 billion, while adjusted operating profit reached approximately $2.1 billion. Adjusted operating margin expanded to approximately 20.4%, adjusted diluted EPS reached $4.20, and adjusted free cash flow was approximately $1.9 billion. The company also ended 2025 with relatively low leverage, giving management substantial financial flexibility. 2026 has become an even stronger year for Vertiv. In the second quarter of 2026, revenue reached approximately $3.27 billion, representing about 24% year-over-year growth. Operating profit increased approximately 44%, while adjusted operating profit increased around 51%. Adjusted operating margin reached approximately 22.6%, demonstrating that Vertiv is not only growing rapidly, but also becoming more profitable. Adjusted EPS increased approximately 60% to $1.52, while adjusted free cash flow reached approximately $925 million during the quarter. Management has raised its 2026 outlook and now expects approximately $14.0 billion of revenue at the midpoint. That represents a significant increase from 2025 and demonstrates the strength of current data center demand. My base case model uses approximately $14 billion of 2026 revenue, with adjusted EPS around $6.70. If Vertiv can maintain strong order growth and execute its capacity expansion successfully, 2026 could become an important earnings acceleration year. For 2027, I expect growth to remain strong, but gradually normalize from the exceptional levels seen during the current AI infrastructure cycle. My bear case estimate is approximately $16 billion of revenue, my base case is approximately $17.5 billion, and my bull case is approximately $19 billion. The base case assumes continued hyperscaler spending, increasing adoption of liquid cooling, expanding data center power requirements, and continued demand from AI infrastructure customers. Margin expansion is another major part of the VRT story. Vertiv's adjusted operating margin increased to approximately 22.6% in Q2 2026, compared with 20.4% for 2025. If the company continues benefiting from scale, product mix improvements, manufacturing efficiency, and higher value AI infrastructure solutions, adjusted operating margins could potentially reach approximately 23% to 24% in 2027. At $17.5 billion of revenue and a 23.5% adjusted operating margin, adjusted operating profit could approach $4.1 billion. My base case 2027 adjusted EPS estimate is approximately $8.50. In a weaker scenario, EPS could be around $7.40, while a stronger AI infrastructure environment could potentially push EPS toward $9.50 or higher. The important factor is that earnings could grow faster than revenue if Vertiv continues expanding margins. This operating leverage is one of the strongest reasons investors are willing to pay a premium valuation for the company. Liquid cooling could become one of Vertiv's most important long-term growth opportunities. Traditional air cooling becomes increasingly challenging as AI processors and server racks consume more power and generate more heat. Liquid cooling technology can provide more efficient thermal management for high-density AI environments. Vertiv is expanding its manufacturing capabilities for AI-ready cooling solutions, positioning the company to capture increasing demand as data center architecture evolves. Vertiv's cash generation profile has become another major strength. The company generated approximately $1.9 billion of adjusted free cash flow in 2025, while Q2 2026 alone produced approximately $925 million of adjusted free cash flow. Strong cash generation gives Vertiv the ability to invest in manufacturing capacity, research and development, acquisitions, debt reduction, and potentially shareholder returns. The company also moved into a net cash position during Q2 2026, significantly strengthening its balance sheet. Vertiv competes with major infrastructure companies such as Schneider Electric and Eaton, but its competitive advantage comes from its broad portfolio across power and thermal management. Vertiv can provide multiple components of a modern data center infrastructure system, including UPS, power distribution, cooling, liquid cooling, racks, monitoring, and services. As customers build increasingly complex AI data centers, the ability to provide integrated infrastructure solutions could become increasingly valuable. The long-term AI opportunity remains the most important growth driver. The relationship is straightforward. More AI GPUs require more electricity. More electricity generates more heat, and more heat requires more sophisticated cooling. This creates a powerful infrastructure cycle for Vertiv. If global AI investment continues growing throughout 2027, Vertiv could benefit from both higher equipment volumes and higher infrastructure spending per data center deployment. Using an illustrative discounted cash flow framework with strong free cash flow growth through 2030, a discount rate around 9%, and a terminal growth rate around 3.5%, I estimate a broad intrinsic value range of approximately $250 to $290 per share in the base scenario. A weaker environment could produce a valuation around $190 to $220, while a stronger AI infrastructure cycle could justify approximately $330 to $380. Because DCF valuations are highly sensitive to growth and discount rate assumptions, these figures should be viewed as valuation scenarios rather than precise predictions. My 2027 valuation framework gives a bear case target of approximately $185, a conservative target around $240, a base case target around $300, and a bull case target of approximately $350 to $380. An extreme bull case could potentially push the stock above $400 if Vertiv reaches approximately $10 or more in 2027 EPS, and investors continue assigning a premium multiple to AI infrastructure companies. For VRT to reach or exceed $400, several things would need to happen simultaneously. AI data center spending would need to remain extremely strong. Vertiv would need to maintain high 20% or better revenue growth for longer than expected. Margins would need to continue expanding, and investors would need to maintain a premium valuation multiple. A $10 EPS result combined with a 40 times earnings multiple would produce approximately $400 per share. This is possible, but I consider it an aggressive bull case rather than the most likely outcome. The biggest risk is valuation. Even if Vertiv continues delivering excellent operating results, the stock could decline if investors decide that its earnings multiple has become too high. Another major risk is a slowdown in AI-related capital expenditure by hyperscalers. Competition from companies such as Schneider Electric and Eaton is also important. Supply chain constraints, manufacturing execution, customer concentration, and a potential normalization of AI infrastructure spending could also create volatility. In other words, the business fundamentals can remain strong while the stock still falls because expectations are already extremely high. In my bull case, AI infrastructure investment remains exceptionally strong through 2027. Vertiv continues gaining market share. Liquid cooling becomes a major growth engine. Margins move toward the mid-20% range, and EPS approaches $9.50 to $10. Under those conditions, a valuation of approximately 35 times to 40 times earnings could produce a share price around $330 to $400 or higher. This scenario would make VRT one of the strongest beneficiaries of the AI infrastructure cycle. In the bear case, hyperscaler spending slows significantly. AI data center construction begins normalizing. Revenue growth falls into the low to mid-teens, and valuation multiples contract. EPS could be closer to $7.40, and a 25 times earnings multiple would produce a value near $185. This illustrates the major weakness of the current setup. Even with continued earnings growth, multiple compression could create substantial downside if the market becomes less optimistic about AI infrastructure. I would give Vertiv approximately 9.5 out of 10 for revenue growth, 10 out of 10 for AI exposure, 9 out of 10 for margin expansion, 9 out of 10 for free cash flow, 9 out of 10 for balance sheet strength, and 9 out of 10 for competitive positioning. The biggest weakness is valuation, where I would give the stock around 5 out of 10. Overall, VRT has outstanding fundamentals, but the stock price already reflects a significant amount of future growth. Vertiv is one of the strongest fundamental AI infrastructure stories for 2026 and 2027. The company combines rapid revenue growth, expanding margins, strong free cash flow, improving balance sheet strength, and direct exposure to the increasing power and cooling requirements of AI data centers. My base case assumes approximately $17.5 billion of 2027 revenue and $8.50 of adjusted EPS, producing a 2027 price target around $300. My bull case target is approximately $350 to $380, while an extreme bull case could reach $400 or more. However, because valuation is already demanding, my overall rating at current levels is hold, with a preference to accumulate on significant pullbacks.